Today, I'd like to do a quick reaction to Steven Lim's idea whereby he sold away his property and used all the proceeds to buy one stock.
I put it all in one stock.
Whoa.
Just one stock.
What?
Yes, you heard it, one stock, which means all in into this one stock. And as you can guess, as a heads up, I'll be slaughtering that idea because you know what I believe in. But more importantly, let's not mock about it because at the end of the day, it's still his own money. Let's try to be kind in the comment sections, definitely. And what we want is to find constructive ideas and critique on what are the pros and especially the cons of doing so. So if you want to hear more positive ideas, continue watching on. Hi guys, welcome back. Let me share with you the breakdown for today's whole tutorial. The first is I'd like to highlight certain biases that I'm guessing Steven actually has right now, and maybe this can help improve your own thinking process also. The second, I'll be deep diving into Singpost. I'll be giving you an analysis of it just in case you are also a shareholder of Singpost. The third, I'll be critiquing this idea of going all in into one company. And last but not least, let's touch on the whole idea of investing in one stock for retirement. Because Steven has shared that this amount of wealth he has built and these investments he believes he's calculated that he can eat Haidilao for 16 years with a partner. Now, so I've also prepared some math, some fun to things, so stay tuned right to the end. Without further ado, let's dive on to the first segment for today, which is highlighting biases and critiquing, regardless of what company anybody buys, these biases need to be avoided. Let's play on a clip by Steven on why he's actually bought Singpost in the first place.
Steven Lim.
Okay, just between you and me, Singpost lah.
Singpost, really?
Yeah.
What do you think gives you this confidence in the company?
Because I know that people still need the product, and they are also not in Singapore. They are doing globally their trades, their services as well.
First and foremost, being global doesn't mean that the company is protected from downturns. It simply means that probably has a bigger addressable market, and probably it's trying to build a global brand that can give it a more sustainable competitive advantage. But many companies have also, in their process of trying to expand, burn away capital, and in the end saw downturn come faster than not. And to this point that Steven has mentioned, people still need this product. Now, this logic when buying a company is particularly dangerous. In any case, we can apply this logic to many companies also. He is probably familiar with DBS. I guess you and I, we are also. He can also buy into CapitaLand. CapitaLand, owns malls and properties, correct? They are going nowhere. He can also buy into Singtel, one of the owners of Singpost in any case, because Singtel owns critical infrastructure that is still needed regardless of how our economy really shapes. So these companies definitely do qualify as people still needing this product. But you know what? As investors, we need to guess whether moving forward, people will still need this product or not, because that is where disruption comes in, correct? The easy part is knowing that people needs it now. The hard part is determining the demand moving forward. If you don't know, Singpost is now pivoting away from its post and parcel service. As we know and love Singpost is because our usual postman that comes around and delivers our letters, that core business is really dwindling. The key driver moving forward for it is actually logistics. On a year-on-year basis, letter volumes have dropped yet again, dropping by 8%. So understanding these biases are important. Make sure that the company still has demand moving forward. And that leads to the next segment for today, which is doing a quick analysis on Singpost. If you see latest news articles, it's actually quite disturbing. Singpost's first quarter 2022 operating profits have fallen by 47%. The simple reason, higher costs, post and parcel weakness, something I've mentioned already, an 8% drop. If you look for numbers, you see that group revenue has surged up, correct, by 34.7%. That looks great. However, group operating expenses have also ballooned up by 39.8%. So net, if revenue goes up by this, operating expenses go up by this, you realize that operating profits have dropped. Dropped by how much? 46.7%. So what's going on exactly with Singpost? In 2018, Singpost's key three segments are postal, logistics, and e-commerce. Postal was the key. Postal is where Singpost actually has a monopoly. The rest of the business segments, they actually may not have a sustainable competitive advantage. Singpost has actually sold away this e-commerce portion whereby it's actually previously invested in some US e-com, and that has lost money and they've divested it away. So moving forward, if you see in 2022, The three segments are now logistics, postal, and then property rental in sequence of size. Now, postal has seen year-on-year declines, correct? Previously, it's 41% of total revenues, but right now, as you can see, it's only 36%. Logistics is now the savior of the company. It has grown up to 59%, but logistics, as you can guess, is a low-margin business. If you click a button, you can actually see the gross margins have actually dropped. And then the EPS, earnings per share, has dropped across these years. This is a reason why Singpost has performed poorly in terms of its share price. Now, if you like to make informed decisions on whether this company is good to invest, or if you like to compare it against other companies, simply look for Moomoo's platform, who is today's proud sponsor. If you have been using a traditional broker and you like to try out this fantastic platform, do use my referral codes below, and in this period, there is a promotion whereby you get free stocks with a new sign up. The sign up process is easy. You simply can use my info and make a minimum deposit of at least $2,700 and start trading with it. Very soon you get to see how user-friendly the interface really is. So as a shout out again, look for my referral codes below and get started today. Now back to the operations of Singpost. Let me show you more details. Singapore used to be 52% and Australia used to be only 13% in 2018. That's where we all grown to know Singpost a bit better, because they are a dominant force in Singapore and we see the postal people moving in and out of our neighborhoods. But fast forward to today, Singpost only derives 43% of revenue from Singapore. Australia now has ballooned to a 27% contributor. My key question is, are you still familiar with it as a household brand or not? Are you still comfortable with the risks that Singpost is taking on in terms of its operations? All these are questions when you put on the hat of a business owner, and it should help you understand whether you are comfortable investing into a particular share or not. With that, let's move on to the third segment for today, which is getting all in one particular stock. Now let's hear how much Steven has actually invested.
Serious?
Yeah.
You went all in on Singpost stock?
I actually invested nearly about 300,000
In Singpost?
all in Singpost.
Real people go all into one company.
Now Steven does sound passionate, but my gut feeling is we also have to take that message with a pinch of salt, because his background is in entertainment. And with regards to that comment on real people go all in, I guess there are some people that should really go all in. You know, Steve Jobs went all in on his company, Apple. Warren Buffett is actually all in into Berkshire Hathaway. But let that be the minority of people, whereby they are the real business owners themselves. They tie their fortunes to their own companies. For the rest of us, especially if you are looking to invest for financial freedom and also for retirement, we are probably better off being diversified. Now, his decision to buy Singpost and getting all in sounds a bit emotional to me. My guess is maybe he's recently been to Singpost HQ and seen that it's been doing well, or he knows someone who's shared stories of Singpost doing well and he's gotten some recency bias. That could be one. Or that something with Singpost resonated massively with him. He's pleased with them. You know, it's a bit like the first time you jump into a Tesla car. It seems like a mind-blowing experience and you have that feel-good factor. And that emotion actually drives you to believe that the company is definitely a good investment. So understanding these human emotions that we all have, we should always take note and remove away such things from the equation of investing. Secondly, the pace of him buying is something that I like to critique. Now, even if you have sold away a house, you have gotten a big influx of capital. Buying everything one shot is not likely a good idea. Why do I say so? You know, when it comes to relationships also, when we build relationship with someone long-term, slowly, you realize that we will hang on through bad times also a bit better. You go in fast, you come out fast. So the best is to slow down. You know, Steven, if you're listening in, if you have bought Singpost over 10 repeated times, over 10 months maybe, you'd reinforce to yourself a bit better whether it fits you, whether you still love it or not. And you have reinforced 10 times, it's much easier to hold on long term. So as always, if you want to be a long-term investor, reflect that in the buying process also. It will definitely help you ride out difficult times. And I have a particular trait that I share with Steven, which is to act fast. And the wisdom that I like to keep close to heart is that we always need to understand the market is always there. Opportunities are always there. Remember it and remove away any haste in decision making. Let's move on to the fourth segment for today, which relates to retirement. Let's play what Steven has actually shared.
I'm looking for
The end game.
The end game, you're right. I can actually eat Dingtaifung or Haidilao for 2 person for continuously every single day for 16 years.
16 years, right?
I'm not kidding, I calculate already.
So you
Now, Steven, if you are listening in, betting into a particular company, one single stock, is highly risky. If there's something that goes wrong with operations, you realize that the share price performance tanks. And if you need to consume it for retirement, then you might sell things at a loss. The second part is when you buy only one company for dividends, you realize that there could be periods where there are dividend cuts. Then that's definitely not helpful for retirement cash flow. If the end game is to last 16 years in retirement with that capital and that cash flow produced from that asset, then it's actually quite contrary to making big all-in bets. The next part about what Steven has shared is that he believes that what he has is enough for him and a partner for Haidilao or Dingtaifung for 16 years. Now, I actually like that he can quantify it simply because it helps to understand how much you have, whether you have enough. And you know, the simplest way to be happy is to be satisfied and to be grateful. So if you measure that you have enough, it's really easy to feel happy. So I've actually prepared this segment to share with everybody on the numbers needed to have this kind of a lifestyle. So let's put on the low end, eating Dingtaifung and Haidilao every day for 16 years, how much it will cost. My lowest guess is it'll be $100 per day, especially when there's 2 people factored in. If food inflation is 5% per year, then we'll input that with a 5% per annum inflation rate. Then let's put it on a scale whereby on the top end, what is the minimum needed? Say everyday eating Dingtaifung and Haidilao needs more than $100. You've been there yourself, you kind of feel that you spend more. Let's put it at $125 per day instead. And let's use a higher inflation rate. Now on this channel, you've heard me share a lot on inflation, but I've also seldom mentioned something. You know, when it comes to products and services, the rate they inflate is also different. The top end of products and services will inflate differently from the bottom end, which means a Ferrari's price will inflate way faster than a mass market car. You realize that a branded bag will inflate way faster than a mass market bag. You realize that Dingtaifung Haidilao will inflate their menu prices way faster than basic food. Hence, let's input a 10% year-on-year inflation for 16 years. So in the first scenario, we use $100 per day for 5%, add 5% for 16 years. That will require an investment pot of $863,000. Now on the top end scale, let's put $125, add 10% per annum for 16 years. That will be $1.64 million. So this is the range we have. $863,000 on the lower end to $1.64 million on the higher end. So Steven, if you have this amount, congrats, I validated that it's enough. On the other hand, if you have more than that, that's great, because that means you can actually sustain this lifestyle of what you like for even a longer period than 16 years. So if you have had fun in this whole discussion, smash the like button as always. And with that, smash or subscribe also, because thinking through this case, I've came up with a new concept that I'd like to introduce to everybody. What are my top 20 stocks to invest for 20 years? Can it be done? When I was thinking about it, I definitely didn't put Singpost in that list. I have 20 names that I'd like to share with everybody that are quite possibly better ideas, in my opinion at least, to invest for the next 20 years. So if you're keen, smash or subscribe. Stay tuned for it and leave in the comment sections what you guess they are. Who are the number 1, number 2, number 3 that I have on my list. Maybe some names might shock you. So stay tuned for it, and I'll see you then too. Take care as always. Goodbye.